Right now, the United States controls the dominant financial system on the planet. The dollar dominates global trade. The Federal Reserve in Washington moves markets with a single sentence. American banks hold trillions in deposits backed by government guarantees. But none of it existed before 1862. For most of American history, there was no paper money, no central bank, no income tax, and no deposit insurance. Everything you take for granted about money in this country was invented in a crisis by people who were making it up as they went along. Picture the United States in 1840. You walk into a general store in Philadelphia to buy a sack of flour. You hand the merchant a banknote. He picks it up, squints at the print, then pulls a thick guidebook from under the counter. He flips through pages of tiny text comparing your note to a list of known counterfeits, checking which banks are still solvent and which ones collapsed last month. After a full minute of this, he tells you the note is only worth 60 cents on the dollar because the bank that issued it is 300 miles away in Ohio, and nobody around here trusts it. That was money in America before the Civil War. There was no national paper currency, not a single bill issued by the federal government in Washington. Instead, over 1,600 state-chartered banks printed their own money. Each bank designed its own notes with its own artwork, its own denominations, its own promises. The result was more than 8,000 different types of banknotes circulating at the same time across the country. Some were legitimate. Many were not. Counterfeiting was so rampant that merchants relied on published guides called banknote reporters, thick booklets updated regularly that listed every known banknote in circulation alongside warnings about which ones were forged and which issuing banks had already gone under. And the banknote problem got worse the farther you traveled. A banknote from a reputable bank in New York might lose half its face value by the time you reached Virginia, simply because nobody that far south could verify whether the bank was real. The phrase, "not worth a continental," which Americans still use today, came from this era. It originally described the worthless paper currency printed during the Revolutionary War, but it stuck around because worthless paper money kept showing up for decades afterward. The era from 1837 to 1863 was called the Free Banking Era, and the name makes it sound a lot more orderly than it actually was. States chartered banks with minimal oversight. Some of these banks existed only on paper. They were called wildcat banks because they deliberately set up offices in remote backwoods locations where wildcats roamed, making it nearly impossible for anyone holding their banknotes to travel there and redeem them for actual coin. The whole business model was to print paper, circulate it as far away as possible, and hope nobody showed up at the door asking for gold. Meanwhile, the federal government ran on coins. Gold eagles, silver dollars, copper cents. Hard metal coins you could weigh and verify. But coins had their own problems. They were heavy, slow to transport, and there simply were not enough of them to support a growing national economy. If you wanted to move a large sum of money across the country, you physically shipped crates of gold and silver by stagecoach and hoped nobody robbed you along the way. Then the Civil War changed everything. The Union needed money to fight, and it needed it fast. Taxes and coin reserves could not cover the cost, so in 1862, Congress passed the Legal Tender Act and authorized the printing of federal paper currency for the first time in American history. They called them greenbacks because of the green ink on the back. The government printed $450 million worth of them during the war, and for the first time, every American was holding the same kind of money. The Confederacy printed its own paper money too, but without the economic base to back it up. By the end of the war, Confederate dollars were worth less than the paper they were printed on. The man behind the Union's greenbacks was Treasury Secretary Salmon P. Chase, and in a move that tells you everything about the era, Chase put his own face on the first $1 bill. Chase was not the president, not a founding father, just the guy in charge of the money, and he decided he deserved to be on it. But paper money solved only one problem. The deeper issue, the one that would haunt America for another 50 years, was that there was no central institution managing any of it. Most countries had a central bank by the mid-1800s. England had the Bank of England. France had the Banque de France. America had nothing. And the reason America had nothing is one of the strangest stories in financial history. The United States actually built a central bank twice and destroyed it both times. Alexander Hamilton created the first Bank of the United States in 1791. He modeled it on the Bank of England and argued that the new republic needed a single institution to manage currency, hold government deposits, and stabilize the economy. Thomas Jefferson hated the idea. To Jefferson, it was a tool for wealthy Northeastern bankers to control the country. The two men fought bitterly over it, and when the bank's 20-year charter expired in 1811, Congress refused to renew it. 5 years later, after the War of 1812 exposed the chaos of running a country without a central bank, Congress created the Second Bank of the United States. It operated for 20 years. Then Andrew Jackson came along. Jackson despised the bank with a personal fury that went beyond politics. He saw it as a corrupt monopoly that enriched elites at the expense of ordinary citizens. When the bank's president, Nicholas Biddle, applied for an early recharter in 1832, Jackson vetoed it with a message so blistering it became one of the most famous presidential statements in American history. He called the bank a monster. He called it a threat to democracy. And when he won re-election that year, he took it as a mandate to destroy the institution entirely. He pulled all federal deposits out of the bank and scattered them across dozens of state banks. Jackson considered killing the bank his greatest achievement. He reportedly wanted "I killed the bank" inscribed on his tombstone. And for the next 77 years, from 1836 to 1913, the United States was the only major economy in the world without a central bank. The consequences were predictable and devastating. Without a central bank, there was no lender of last resort. When a bank failed, it just failed. When depositors panicked, there was no institution with the authority or the resources to step in and restore confidence. Financial panics became a recurring feature of American life, striking with brutal regularity roughly every 20 years. The Panic of 1819, the Panic of 1837, the Panic of 1857, the Panic of 1873, the Panic of 1893. Each one followed the same pattern. Banks overextended, confidence cracked, depositors rushed to withdraw, and the entire system buckled. During these panics, banks simply suspended withdrawals. Your money was in there, sitting in a vault, and you could not touch it. Families who had saved for years watched helplessly as their bank locked the doors and told them to come back later, if the bank survived at all. And here is where it gets truly bizarre. Because there was no central bank, a single private citizen ended up filling the role. His name was John Pierpont Morgan, and by the 1890s he was the most influential private financier in the country. In 1895, the United States Treasury was running out of gold. The government was on the verge of defaulting on its obligations. There was no Federal Reserve to intervene, no emergency lending facility, no institutional safety net of any kind. So J.P. Morgan personally organized a rescue. He formed a private syndicate that supplied the Treasury with $62 million in gold, enough to prevent a sovereign default. One private citizen bailing out the government of the United States because no institution existed to do the job. 12 years later, it happened again, and this time the scale was even more dramatic. The Panic of 1907 hit after a failed attempt to corner the copper market triggered a cascade of bank failures. Trust companies in New York started collapsing. The stock market dropped 50%. Depositors lined up around city blocks trying to pull their money out before their bank went under. Morgan, now 70 years old, took charge. He summoned the leading bankers of New York to his private library on Madison Avenue, locked the doors, and told them nobody was leaving until they agreed to put up the money to stop the bleeding. He personally reviewed the books of failing institutions, deciding which ones to save and which ones to let die. For several weeks, one elderly man in a mahogany-paneled library on the east side of Manhattan was effectively running the American financial system. It worked. The panic subsided, but the message was impossible to ignore. The richest country in the world could not keep relying on one man's willingness to save it. Therefore, the push for a real central bank became unstoppable. But the men who designed it did not want the public to know what they were doing. In November 1910, 6 men boarded a private rail car at a train station in Hoboken, New Jersey. They told anyone who asked that they were going on a duck hunting trip. They used first names only, some of them fake, to avoid being recognized by reporters. Their destination was Jekyll Island, a private resort off the coast of Georgia owned by a club whose members included the Morgans, the Rockefellers, and the Vanderbilts. The 6 men represented roughly 1/4 of the entire world's wealth. Senator Nelson Aldrich, the chairman of the Senate Finance Committee and father-in-law to John D. Rockefeller, Jr., Henry Davison, a senior partner at J.P. Morgan, Benjamin Strong, the head of Bankers Trust, Paul Warburg, a partner at the investment bank Kuhn Loeb, and the man who arguably knew more about central banking than anyone in America, Frank Vanderlip, president of National City Bank, the largest bank in the country, and Abraham Piatt Andrew, the assistant secretary of the Treasury. For 9 days, These 6 men drafted the blueprint for what would become the Federal Reserve System. The arguments centered on the balance of power between government and private banks. Should the system be centralized in one location or distributed across multiple regional banks? In the end, they hammered out a compromise designed to look like it was not controlled by Wall Street, even though the men designing it were Wall Street. The plan was reworked over the next 3 years by Congressman Carter Glass and Senator Robert Owen, who made it more politically palatable by adding layers of government oversight. President Woodrow Wilson signed the Federal Reserve Act into law on December 23, 1913, the day before Christmas Eve, when most of Washington had already gone home for the holidays. The final design was deliberately ambiguous. It was not fully government and not fully private. 12 regional reserve banks spread across the country provided the appearance of decentralization, while a board in Washington gave the government oversight. It was a compromise built to satisfy people who would never fully trust each other. And remarkably, that was not the only seismic change that happened in 1913. Earlier that same year, the 16th Amendment to the Constitution was ratified, giving Congress the power to levy a federal income tax. For the first time in peacetime, the government could tax individual Americans based on how much they earned. Before 1913, the federal government funded itself almost entirely through tariffs and excise taxes. Import duties on foreign goods and specific taxes on products like whiskey and tobacco covered the bills. No individual American sent a percentage of their paycheck to Washington. The system had been running this way for over a century, and plenty of people in positions of influence wanted to keep it that way. But tariffs had a fundamental problem. They taxed consumption, which meant they hit poor Americans harder than rich ones. A factory worker spending most of his wages on food and goods paid a higher effective tax rate than a railroad baron, whose wealth sat in stocks and real estate. The populist and progressive movements of the late 1800s seized on this disparity and pushed for an income tax as a way to shift the burden from consumption to wealth. The fight lasted decades. When Congress finally passed a peacetime income tax in 1894, the Supreme Court struck it down as unconstitutional, and it took another 19 years and a constitutional amendment to make it legal. The initial income tax was almost comically modest by modern standards. It was 1% on incomes above $3,000, which adjusted for inflation is roughly $92,000 today. Only the top 3% of earners qualified. When the first tax returns were filed in 1914, just 358,000 Americans owed anything at all. The original 1040 form was a single page with a single page of instructions. But war changes everything. By 1920, the top marginal rate had climbed to 73% to pay for American involvement in World War I. The income tax went from a minor levy on the wealthy to the single largest source of federal revenue, and it has stayed there ever since. Think about what had happened in a single year. In 1913, the United States went from a country where the government had no authority to tax your income and no institution to manage the money supply to one that had both. Congressman Cordell Hull of Tennessee drafted the implementing legislation for the income tax. Carter Glass of Virginia shepherded the Federal Reserve Act through the House. Two sweeping changes to how America handled money, both signed into law within months of each other. The modern financial state, the one that would eventually fund 2 world wars, build the interstate highway system, and manage the largest economy on Earth, was born in that single calendar year. So by 1920, America finally had paper money, a central bank, and an income tax. The financial architecture was taking shape. But there was still a gaping hole in the foundation, and it took the worst economic catastrophe in modern history to expose it. If you are finding this useful, consider subscribing. This channel covers the hidden origins of the systems that run your life, and there is a lot more to come. Now, back to that gaping hole. Between 1921 and 1929, an average of 600 American banks failed every single year. 600 per year, and that was during the good times, the roaring 20s and the jazz age and the great bull market on Wall Street. Even during a period of extraordinary economic growth, hundreds of banks were quietly collapsing, and when they did, depositors lost everything. There was no insurance, no guarantee, and no safety net. If your bank went under, your savings vanished. Every dollar you had earned, every paycheck you had deposited, every penny you had set aside for your children or for retirement, gone. You had no claim and no recourse. Families who had spent decades building modest savings watched it disappear overnight because a bank officer in another state made a bad loan. And there was nothing unusual about this. It was simply how banking worked. You deposited your money and you accepted the risk that you might never see it again. Then the Great Depression arrived and turned a chronic problem into an existential crisis. Between 1930 and 1933, more than 9,000 American banks failed. 9,000. Roughly $7 billion in deposits disappeared, money that ordinary families had saved over entire lifetimes. The cruelty of bank runs was that they became self-fulfilling prophecies. The moment you heard a rumor that your bank might be in trouble, the rational thing to do was rush down and withdraw everything before the vault was empty. But when everyone followed the same rational logic at the same time, the bank collapsed under the weight of simultaneous withdrawals, even if it had been perfectly solvent the day before. Individual rationality created collective disaster. By March 1933, when Franklin Roosevelt took office, the banking system had essentially stopped functioning. Roosevelt declared a national bank holiday, shutting down every bank in the country for 4 days while officials inspected the books and decided which ones could reopen. The solution came from an unlikely direction. Congressman Henry Stegall of Alabama pushed for federal deposit insurance, the idea that the government would guarantee individual bank deposits up to a certain amount. Roosevelt initially opposed it. The major banks opposed it because they did not want to pay insurance premiums that would subsidize their smaller competitors. But Stegall kept pushing, and the Banking Act of 1933 created the Federal Deposit Insurance Corporation. The initial insurance limit was $2,500 per depositor. It was a modest guarantee, but the psychological effect was immediate and staggering. In the year before the FDIC, roughly 4,000 banks had failed. In the first full year after deposit insurance took effect, 9 banks failed. 9. The number dropped from 4,000 to single digits in a single year, not because the underlying economics changed overnight, but because the guarantee eliminated the incentive to panic. If you knew your deposits were insured, you had no reason to rush to the bank and withdraw, and if nobody rushed to withdraw, the bank did not collapse. The self-fulfilling prophecy ran in reverse. The FDIC has never failed to pay an insured depositor, not once in over 90 years of operation. Today, the insurance limit is $250,000, and it remains one of the most quietly effective institutions in American history. But even with a functioning domestic banking system, America was not yet the center of the financial world. The British pound sterling had been the dominant global currency for over a century, and London was still the capital of international finance. That changed in the summer of 1944, in a hotel in the mountains of New Hampshire. 2 world wars had bankrupted Britain. The empire was crumbling, the pound was collapsing, and the United States had emerged from the wars as the world's largest creditor nation, holding most of the planet's gold reserves. The question was no longer whether the global financial system needed a new anchor. The question was what that anchor would be. In July 1944, 730 delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire, to design the post-war global monetary system. The conference lasted 3 weeks, but the real battle was between 2 men. On the British side was John Maynard Keynes, the most famous economist alive, a man whose ideas had reshaped how governments thought about money, employment, and the role of the state. Keynes proposed creating a new international currency called the Bancor, a neutral unit of account that would not give any single country an unfair advantage. It was elegant, fair, and designed to prevent the kind of economic imperialism that had destabilized the world before the wars. On the American side was Harry Dexter White, a Treasury Department official with none of Keynes's fame but all of the leverage that mattered. White's proposal was simpler: make the US dollar the anchor of the global system. Peg every other currency to the dollar. Peg the dollar to gold at $35 per ounce. America would guarantee convertibility, and the rest of the world would conduct trade in American money. Keynes was the superior intellect. Everyone in the room knew it. His Bancor system was designed to prevent exactly the kind of imbalance that would later plague the global economy, where one country's currency dominance gives it enormous advantages while forcing other nations to stockpile its money just to participate in trade. It was a system built for fairness. But White had something Keynes did not. He had the money. Britain was broke and desperately needed an American loan to rebuild after the war. The British delegation could not afford to alienate Washington. So they accepted White's terms, and the dollar became the world's reserve currency. Every participating nation pegged its currency to the dollar, and the dollar itself was anchored to gold. If you held dollars, you held something backed by the full gold reserves of the United States. It was not earned through economic theory. It was won through economic leverage. The country with the gold made the rules, and in 1944, that country was the United States. The Bretton Woods system lasted until 1971, when Richard Nixon ended dollar-to-gold convertibility in what became known as the Nixon shock. But by then the dollar was so deeply embedded in global trade that it did not matter. Countries kept using it anyway. Even today, after decades of predictions about the dollar's decline, it still accounts for roughly 58% of global reserves. The system White built at Bretton Woods, the one that Keynes warned would give America too much power, is still running. But there was still one more piece to come. The one nobody planned. The one that happened because a man forgot his wallet. Before 1950, if you wanted to buy something, you needed the cash in hand or you did not buy it. Department stores issued their own metal charge plates, small embossed cards that worked at that store and nowhere else. If you wanted to buy a car or a major appliance, you went through a specific installment finance company that would extend credit for that one purchase. There was no general-purpose way to borrow money at the point of sale. You saved up, you paid cash, or you used layaway, where the store held the item in the back while you made payments over weeks or months. You did not get the product until the last payment cleared. Then, in 1949, a New York businessman named Frank McNamara went out to dinner at a restaurant in Manhattan. When the check arrived, he reached for his wallet and realized he had left it at home. His wife had to come to the restaurant and pay the bill. The embarrassment stuck with him. McNamara's solution was a card that would be accepted at multiple restaurants, so no one would ever be caught without a way to pay again. In 1950, he and his partner, Ralph Schneider, launched the Diners Club card. It was not a credit card in the modern sense. You paid the full balance at the end of each month, but it introduced a concept that had never existed before. You could walk into a business and pay with a piece of cardboard instead of cash. The real revolution came 8 years later, and it came from an idea so aggressive it would be illegal today. In 1958, Bank of America decided to test the concept of a general-purpose credit card, one that could be used at any store, not just restaurants. They needed a test market. They chose Fresno, California, a mid-sized city large enough to generate data but small enough to contain the experiment if it went wrong. Then they did something that still sounds unbelievable. They mailed 60,000 unsolicited credit cards to the residents of Fresno. Nobody had applied for them. Nobody had been through a credit check. The cards just showed up in mailboxes across the city with a note explaining how to use them. They called it the Fresno Drop, and it was financial chaos. Fraud exploded immediately. People who never asked for a card suddenly had one, and some of them used it recklessly. Criminals intercepted cards from mailboxes and went on shopping sprees. Delinquency rates were astronomical. Bank of America lost millions in the first year. But the concept worked. Merchants signed up because customers were spending more. Customers signed up because merchants accepted the card. The network effect took hold, and within a few years, the Bank of America card had spread across the country. It was eventually renamed Visa. D. Hock, the executive who built the bank card network into a global system, created the infrastructure that now processes billions of transactions every day. Before 1958, the concept of buying something you could not afford and paying interest on it over time did not exist as a mass consumer behavior. Layaway existed, but under that system, you paid first and received the goods only after the balance was settled. Credit cards flipped that equation. You got the thing now and figured out how to pay for it later. Total American credit card debt today exceeds $1 trillion. The average American carries 4 cards. And it all started because a man forgot his wallet at dinner. Step back and look at what happened in less than a century. In 1862, Americans carried coins and dubious paper from private banks that might be worthless by Tuesday. By 1950, they had a national currency, a central bank, a federal income tax, government-insured deposits, a dollar that dominated the planet, and a small plastic card that would eventually allow them to buy anything, anywhere, on borrowed money. Not one of these systems was inevitable. Every single one was born from a specific crisis designed by specific people and opposed by entrenched interests that fought to stop it. Andrew Jackson killed the central bank because he believed it was corrupt. J.P. Morgan saved the Treasury because no one else had the authority or the resources. 6 bankers met in secret on a private island because they did not trust the public to accept what they were building. A congressman from Alabama pushed deposit insurance over the objections of the president himself. And a British economist lost an argument at a mountain hotel because his country was too broke to win it. The financial system you use every day is not a machine that was engineered from a master plan. It is a patchwork of emergency fixes, political compromises, power plays, and accidents. And every piece of it was built by people who were reacting to a disaster they did not see coming. If you want to see how the rest of America's institutions were built, the ones beyond money and banking that you never think about until they stop working, hit subscribe. That story is coming next.